Today we're talking about one of the most surprising assets of 2024, gold. Up nearly 18% so far this year, gold prices are hitting record after record. Why is this happening? Can it continue? And how can investors take advantage of it? We're going to be answering those questions and much, much more with the help of three experts who I have here with me today. By the way, I'm Sumit Roy, Senior Analyst here at ETF.com, and I'm going to be moderating today's webinar. The first part of this stream is going to be a discussion between myself and our guests, and that'll be followed by a Q&A session with the audience, so be sure to get your questions in. Okay, so without further ado, let's get into the webinar. First, why don't I have our guests introduce themselves to the audience and say a few words about themselves. Bob, why don't we start with you, then we'll have Joe and Jeremy go after that.
Hey folks, I'm Bob Elliott. Been a systematic investor for 20 years and was on the investment committee at Bridgewater Associates. More recently, I started Unlimited, which is focused on bringing sophisticated investment strategies to every investor using hedge fund replication approaches. And while I don't have a product on the market related or directly related to gold, I am long an analyst in the gold market, as well as an advocate for thinking about gold as part of a strategic portfolio.
Hello, everyone. I'm Joe Cavatoni. I am a senior market strategist for the World Gold Council for the Americas, as well as the principal executive officer for the Spider Gold Shares GLD and GLDM. I've been with the organization about 7.5 years, a longstanding professional in the financial markets with ETFs as a background, and actually very excited to be here to bring what the World Gold Council can bring to this discussion, which is information, data clarity, and understanding of the gold market. And I'll work with both Bob and Jeremy to complement the conversation around how you should see the ETF market. So happy to be here today.
Great to be with you all here. I'm Jeremy Schwartz, Global CIO at WisdomTree. I've been with WisdomTree really my whole career. I've been there almost 20 years. I started with Professor Siegel. You can see our book together in the background for Stocks for Long Run, the 6th edition. I was his co-author on. So we'll talk a little bit about that. But so I oversee the investment function. We do have a lot of interest in gold. We acquired a European business that has a heavy commodity focus with a suite of gold products over in Europe, but we brought some of that to the US with some interesting concepts that I'm sure we'll talk about. But it's great to be with Joe and Bob and Sumit.
Fantastic. Thank you all so much for being here. So Joe, I want to start with you. You follow the gold market as closely as anyone. Why have prices gone up so much this year?
That's a great question, and it's the right place for us to start. And I think what's really interesting about your introduction around surprised about the performance of gold, I'd start off by saying that we've had record-setting years in terms of the overall demand for gold on a worldwide basis. And that's something that people have to keep in mind. We all want to talk about ETFs and gold ETFs. It's a component of a very, very large market. Now, while we started off with January and February being somewhat flat and kind of slow to get going, what happened in March was tactical activities, in particular speculative traders, both in the US and in some of the Asian markets, started to get involved and look to get ahead of and a jump on this elusive rate cut that I'm sure we'll talk to that's supposed to be coming from the Fed. And that actually started the catalyst for the price up for gold. That's actually been really interesting. You could see that not only in what was playing out in the gold price, but you could see it in the flows in the COMEX futures market, as well as the listed derivatives that are linked to gold-backed ETFs, indicating a net long position, anticipating those rate cuts. Again, that could also be seen in the Shanghai futures market if you were to see the flows and activities in the open positions there. But what's actually really interesting about the move that we've seen and why things are really exciting for investors to pay close attention right now is really that quietly, while that's happening in the US market or the Western markets, what's really been underpinning most of the sustained level of price in gold has been this drift on the east of the price support from investors in the Eastern markets, Asian markets, China, as well as that quiet and ongoing trend that we've been seeing with central bank flows, really keeping the price moving up. So it's been a catalyst in March and into April, but also a very strong support of the price from other sources of flow that many people may not necessarily see and understand, but it's been very substantial, and that's what's been keeping our price moving to these record levels over the last 4 months, 5 months.
Joe, you touched on the Fed, and you also touched on those Eastern markets. I know a lot of people who are watching right now, they're based in the US, and they tend to look at the gold market in a very US-centric way. Can you talk about where gold demand comes from, both from a usage perspective as well as geographically?
Sure. I think it really is important to highlight the fact that gold is a global asset, full stop. And actually, if you understand how gold gets consumed and where it gets consumed, you'll better understand why the price movement has actually been very strong over the last 12 months. I think when you think about geographically, the largest markets for demand for gold are China, India, collectively the Asian markets, but then the Western markets, Germany, the US. So you've got a diverse grouping of different communities that are going to actually be getting engaged and getting involved in consuming gold. It also can be bucketed into four very clear categories of where gold gets consumed. The consumption side, which is mainly jewelry, the investment side, which we all know, and of which ETFs are a component, but then central bank flows in reserve portfolios, and then lastly, technology, which often gets forgotten because it's such a small component relative to the other three. But what we have been seeing over the last 14 years is a trend for central banks to continue to add gold to their reserve portfolio. Again, that's been at a faster pace than we've ever seen it over the last 4 to 5 years, with mainly emerging market central banks picking up gold. But in addition, the shift that we've seen where Western investors have been putting gold on hold in terms of an increase or even taking profit or reducing their allocations to gold, while Eastern investors are taking advantage of the movement in gold and the diversification benefits, and they're adding to it. So simply put, it's a global asset. I think you can see the 4 simple use cases for gold through consumption in jewelry, consumption in investment, and consumption in central banks and technology. The jewelry element usually comes along with lower prices and stronger sentiment around people being comfortable around spending as a consumer. But interestingly enough, it is also a form of savings in markets like China and India. And actually what we've been seeing is support for it, even with the higher prices. That will probably tend to come off a bit as we go into 2024 and continue with these higher prices. But that's where you can see the simple understanding of gold and what's driving it.
So Jeremy, Joe just mentioned that Western investors have been kind of reducing their allocation to gold. I want to ask you about this surprising phenomenon we've been seeing in the gold market this year, and that is the price is surging to record highs, yet we're seeing gold ETFs have outflows. Are you surprised by that, and why do you think that is?
Well, it's definitely an interesting phenomenon when you think about some of these other markets, even just what's happening in the markets today. There's speculation that the SEC can improve Ether crypto, and so it's surging 10-20%. And so like the ETF driving the narrative on for sure in the crypto world is right. But what you're seeing in gold is that it's been the exact opposite. We've actually seen redemptions over the last few years from gold. You're not seeing really ETF investors participate. I think there's some interesting questions like what should the allocation be, how people have been allocated to. You know, our team does a lot of modeling on the gold price, and they have a model that factors in things like real interest rates, the currency, speculative positioning, inflation expectations. Those are sort of the 4 factors they've put together for the model. And you've had, you know, interest rates from the bottom. You know, you had negative real interest rates, and you could say, hey, it used to be where, you know, you had positive carry was a hurdle rate that gold had to outperform. Then you had negative rates and saying, oh, now gold is with a 0, you know, cost of carry when you had bonds being negative carry. You see that was causing a lot of interest in gold. Then rates started rising. All right, now you got more competition that you got to earn a real return with TIPS yields being now 2%. All right, so now you get a real return on bonds back finally. And so that's a headwind to higher gold prices. But the asset allocators, at least from the ETF perspective, have been reducing. I think you say, is there another catalyst for gold? For sure, the central bank buying, China saying, hey, we're going to reduce some of our treasury holdings. Maybe there's all this geopolitical conflict, which tends to be very good for gold. That's one of the things that gold prices do well during geopolitical conflicts. China seeing what happened with Russia and freezing of assets, and maybe they're saying, hey, we want to hold less treasuries, we want to buy more gold. That's obviously one of the big demands. But the question is, will more U.S. and even European investors allocate more? That could be one of the next catalysts to push gold higher.
Just to add to what Jeremy's saying, I think that's an important fact to highlight as well, the systemic risks in the system. If you think about political risks around the globe, if you think about the potential for flare-ups with conflict, et cetera, these are moments when gold shines. And I think that Western investors, while we are seeing redemptions in the ETF market, with the price increase, the overall AUM levels are staying strong. but you're definitely seeing either profit taking or paring back. Opportunity cost is how I'd characterize it, Jeremy. Looking at other assets that might be more stable in terms of the income flows or competing with us on the shorter term. I think that they'll definitely continue to be a headwind amongst the Western investors, but I can't emphasize enough that Western investors need to understand that gold's driven by a global dynamic. And that's why I think that there's still room to run, and still people should be considering these driving factors that are very strong regionally outside of the US.
And if you think about the basic factors that Jeremy highlighted that would typically cause US investors to think about whether or not they want to buy gold, if you look on a global basis, those factors are actually bullish gold, not bearish gold, in the sense of exchange rates, which are falling relative to the dollar, and as a function of that relative to gold. Interest rates that have come down, particularly in China. We've seen, the bond yield come down a fair amount, other asset prices come down. Domestic investors constrained in terms of the attractiveness of various other assets in their portfolio, and a shift by many other global central banks to an easing stance on a forward-looking basis, possibly in a way that is a bit too premature given the global inflationary pressures in place. But like that story, too often US-based investors are looking at US monetary policy, US real yields, and saying that's what's going to drive the gold price in dollars, when the right thing to do is look at the macro fundamentals on a global basis. And when you look at the macro fundamentals on a global basis, actually the moves in gold are pretty reasonable over the course of the last, 6 to 8 months. It's very normal, the set of behaviors we're seeing, not abnormal.
I just pulled up one number. I want to make sure I had the fact check. But our team in Europe produces a lot of documents on this, and they just showed me a chart that showed in 2021, you had about 110 million ounces of gold in the global ETP market. And today it's something like 80 million ounces of gold. So you're down from 110 to 80 million, which shows you, again, how more impressive the price rising is while you've lost 30 million ounces of gold over the last 3 years in these ETPs.
So one point to highlight in terms of a number as well, China, India, and Japan in terms of the ETF flows, smaller markets to the US than the US and maybe Europe for sure, but $2.2 billion of inflows into those markets year to date. So that's actually an impressive number when you think about growing investor demand and a fledgling ETF market in that part of the world. So just to add to what both Jeremy and Bob have said.
Great point. So it certainly sounds like the gold price has been extremely resilient in the face of outflows from US gold ETFs. And I want to touch on, more of the macro outlook that you talked about, Bob. But before we go there, Jeremy, you mentioned that, Ether has been surging lately, and obviously we got the spot Bitcoin ETFs earlier this year. Do you think that, those crypto ETFs could be sucking up money that would have otherwise gone into gold ETFs?
Well, I definitely say, I think of people say, well, how do you think of Bitcoin in a portfolio and what is it? And I've been saying it's sort of this generation's gold in some ways. So you think about the role these assets play in portfolios. Actually in the Stocks for Long Run, we added a chapter on crypto and said Bitcoin is sort of forcing the banking system to be more competitive. Like, why should we only transact 9 to 5 days a week? The Bitcoin is forcing people to say, hey, the banks need to be more competitive. You can now instantly settle a currency, and it's sort of form of a currency. There's a lot of young, passionate people who might have otherwise bought gold who've been buying Bitcoin. So you're saying there is some of that community. I know a lot of those people. But what I thought was fascinating was just how much the ETF is driving the price, like to the point that we were just talking about how the ETF is not driving the price in gold. In crypto right now, the ETF is driving the price, or at least the flows are, the narrative of the ETF coming to market helped put a lot of demand for the crypto, and it's driving up the price. And even just the speculation of the ETF for Ether is driving the price. So it's just sort of interesting how it's the exact opposite today. You could say people are not positioned as much as they could be for gold, given the sort of rising positive trends that it's got.
I'm going to jump in, and I'm sure everybody's expecting what I'm going to say to be something negative, but I'm going to qualify and be balanced with what I bring to this part of the conversation. The first is I'd encourage everybody to check out a survey that State Street Global Advisors did with retail investors in particular. It's on their website, and it talks to the fact that, to my surprise even, younger generations are actually much more active in the gold-backed ETF space than I would have expected. They're a larger component than even the older generation. So there's a lot of interesting research on that website research report that they've got. I'd encourage people to check that out. So there are young people who are still very active and engaging in gold-backed ETFs and using the instruments. But the second thing is I'd like to also highlight the fact that the World Bank just kind of brought out a document that talked about whether or not Bitcoin could be used as a component of a reserve portfolio for central banks. And I think why I'm bringing it up is because I think they lay out a couple of facts, about 6 different points that talk to why I think Bitcoin, while a really interesting asset and a dynamic instrument that could actually, be a part of our future, still has a lot of ways to, a lot of distance to go before it becomes mainstream and adopted. Whether it's from the market capitalization or the liquidity that you're facing, the price volatility, which I think is really, really higher than a safe haven asset would be, and how we should be expecting that to perform. But the adoption of trade flows, the adoption of financial flows, the robust custody system and safekeeping guards, these are all factors that are on the minds of central banks. These are on the mind of the World Bank. These are still factors that need to be developed and worked through, and areas where I think in the case of gold, we've tackled a lot of them, not all of them, but most of them, in a way where you can feel either in a regulated or a self-regulated environment, or with regulated financial institutions offering the services, that you can get that level of comfort and confidence. So my response to a comment around Bitcoin cannibalizing gold would be no real empirical evidence of it. What I would say is if you're adding Bitcoin to your portfolio, you might want to look at the diversification benefits you get from gold.
Bob, what's your take on the whole gold versus Bitcoin debate? Do you think the two can coexist?
Well, I think in general, the statement that Bitcoin is taking money away from gold is poorly supported by factual evidence that you can look at in the 13Fs. Go look at the 13F holders for GLD or some of the other gold ETFs, and go look at the 13F holdings for the big the big spot Bitcoin ETFs. They're not related to each other. The biggest holders in Bitcoin ETFs are hedge funds engaged in a basis trade against short futures and collecting yield. The biggest holders of GLD and equivalent products is basically, long-term institutional investors or people through their various brokerage accounts. And so the two universes are not related to each other. And the reason why we're seeing gold sales in North America is not because of Bitcoin purchases through the spot Bitcoin ETFs. It's not supported by the evidence, and it's a bad theory that can be very explicitly refuted looking at publicly available data. What I'd say in terms of the two assets is that the gold has 3,000 years of history, demonstrating its portfolio responsiveness and its portfolio attributes and its return attributes. And so in that sense, it has there's a lot of clarity and a lot of evidence supporting the way in which you would expect it to perform on a forward-looking basis. Bitcoin has a much smaller, shorter time history in terms of being an asset. During that time, it has performed in ways that have evolved from being like levered NASDAQ to being very idiosyncratic for other reasons. And so when you look at that, it's just frankly, it's a very hard asset to make much of a clear connection to in terms of macroeconomic or portfolio properties, given what we know now. And many of the theories that were promoted and have continued to be promoted about Bitcoin have not, held up to empirical evidence, whether it's an inflation hedge, a hedge against monetary debasement, or a geopolitical hedge. And so I would just say there's a lot more uncertainty about what is likely driving Bitcoin and what is likely to drive it in the future relative to gold, where the return properties are pretty well known, understood, well tested in the portfolio context.
And it's echoed by the fact that the use cases are clear and defined and actually sustained over long periods of time. One last point to add to what Bob has said. This is a 3-year trend we've seen with gold-backed ETFs. It's not a 3-month trend. So we've been seeing the redemption behavior, the opportunity cost challenge, the headwinds Jeremy talked about for gold by Western investors for about 3 years now. So it's not something that's just happened since January when we had these products. One last point on that, maybe stating the obvious, there's been a lot of switching from existing products into the gold-backed ETF. So it almost would have been a surprise if we didn't see the surge in Bitcoin ETFs, I should say. We would have seen a surprise if we didn't see that level of Bitcoin ETF come to market that quickly when they were finally approved by the SEC. That'd be what I'd say.
I just want to make sure we bring less difference between what I first said and what Bob was saying. We're not far apart in our views. The narrative on Bitcoin is at its digital gold. And we actually don't like that narrative that, they're saying that there's 21 million Bitcoins outstanding. So there's this fixed supply, and that's why it's going to have this sort of stable source of value, like where you have a generally stable source of supply of gold and there's not a lot of new mined. We're actually trying at WisdomTree to make gold more transactionable. Like we actually launched our first direct-to-consumer app called WisdomTree Prime, where you could have and basically denominate your spending from a gold account. Like you can buy a gold token in WisdomTree Prime. That's actually digital gold, where you have a digital form of gold, and then you can sort of spend from it very soon, where we're be able to pay your bills directly from a gold token. So that's more like real digital gold. But the narrative that Bitcoin is this digital gold has been out there for a long time. So it's out there in the ethos of what people talk about.
So I think it's a really interesting idea and a really interesting exercise that you guys are going through, Jeremy, in terms of bringing the gold token. And look, we've got an exercise where we're looking to find ways to dematerialize further gold in a way that equities dematerialized over the years, effectively saying, how can you take all of these different versions of gold, turn them into a standard gold unit, and then behind an instrument, for example, like WisdomTree might have, or other utilities for gold, making it even more usable in the financial markets. That's what we're working on through Gold Bar Integrity, a database of all gold, leading to the ecosystem stepping in and working to really make the underlying market much more efficient. And then the wrappers can come, the tokens can come to bring people access to gold. But trying to say that just because there's a limited number of Bitcoin versus, scarcity around mining doesn't necessarily equate. Again, like both Jeremy and Bob have pointed out, the use cases for gold are very clear. And the case is very, very clear in terms of its portfolio contribution, in terms of the diversification benefits, and ultimately the trusted levels of liquidity that you can get from the gold market.
Joe, I know you've also talked about this idea that gold has one big advantage over Bitcoin, and that's the fact that Bitcoin is banned in China, home of well over 1 billion people, while gold is embraced in that country. Can you talk a little bit about that?
Yeah, I think it is an element that actually is interesting for gold, but I think the more interesting element for gold is the fact that it's a longstanding instrument that has a high level of adoption in China for well before even Bitcoin was created. Now, as an organization, World Gold Council worked with China over 15 years ago to lay out a roadmap for trust, transparency, access to liquidity, and actually introduced the Shanghai Gold Exchange, the Shanghai Futures Exchange, and the instruments on gold, and has worked to kind of really bring everything around standards to a point where Chinese investors can feel good and comfortable with it and actually feel really happy about making the investment in gold and not worry about whether or not they're getting the right levels of liquidity or the right price discovery. It's totally transparent. In many ways, onshore in China, the gold market is a microcosm of our ambition for the global market to make sure that we can have one really liquid, transparent price and trust level across the board. It exists there. So I think, yes, the ban has had an impact on some people looking at other assets or not looking at other assets and using gold. But more importantly, you've got a longstanding adoption of gold in the form of jewelry and savings, and now even more a developed market for gold to be traded onshore. I think it's really an interesting market to keep an eye on.
So Bob, we've talked about a lot of the attractive qualities that gold has. How should investors be thinking about gold? What's gold's role in a portfolio? Is it an inflation hedge, a portfolio diversifier, or something else? How should they be thinking about it?
I think in many ways, when you think about gold, what gold is non-interest bearing money. And when you approach that perspective, and when you use that sort of fundamental understanding to apply it to a portfolio context, I think its relationship with other assets becomes relatively clear. It's fundamental relationships. And in particular, what I like to always talk about related to gold from a macro fundamentals perspective is the smile of gold, gold outperforming during periods of high or rising inflationary environments, as well as periods of deflation. And while those periods feel like they're not all that common, if you just look over the course of the last, say, 100 years across major developed economies, we've had periods of either elevated inflation or very low inflation or deflation, something like 15, 20% of rolling 12-month periods. And that's only in the developed world. When you think about it more broadly across the emerging context, that bumps up to 35 or 40%. And so you look at that context and you say to yourself, those are periods where bonds often do poorly relative to gold. And those periods are more common than we probably take for granted. We've been in a period for 30 years of a secular disinflationary environment that has uniquely advantaged bonds relative to other assets, and that is not likely to persist the same way in the future. And even if you don't like the sort of portfolio, the fundamental perspective on gold, if you just look at the empirics, the picture is relatively straightforward. If you were looking for a diversifier to your stock portfolio, you take that stock portfolio, you hold that constant, and you're looking for a diversifier, particularly during periods where stocks underperform. If you look at gold, it outperforms bonds in about half of the rolling 12-month periods where stocks decline. So what that means is in half the cases where you need diversification for your stock portfolio, gold does better than bonds. And yet, essentially every person, I'm sure every person on this webinar and basically every advisor that's out there has their clients invested in bonds. Whereas just from an empirical perspective, gold paints a compelling case. You should put as much gold risk in your portfolio as bond risk you have in your portfolio if you're just looking at the empirical outcomes. And yet everyone holds bonds, and something like 10% of advisor-directed accounts hold gold. And of that, the average holding is something like 1%. So you just look at that. Those two things are way out of whack. And it's surprising because if you look in the last 5 years, the advisors have not taken to gold as that diversifier, as it has provided one heck of a diversification tool relative to bonds during this period.
Well, I love what Bob just said, and I couldn't agree more with everything that he just said. And if I were to add to the point about the diversification, when you think about the role bonds played in portfolios, in the last few decades, you had this deflationary impulse and we had no inflation. And there was this classic narrative of risk on, risk off, and you'd have a recession, stocks do poorly, bonds do well. You'd have a terrorist attack, stocks get killed and bonds do well. You have a financial crisis, stocks get killed and bonds do well. Everything was risk on or risk off, bonds do well. The only thing bonds do not hedge in that sense is inflation. And what do we have now? Very high memories of inflation. And so you look at the correlation of stocks and bonds, and they're skyrocketing. And they're back to levels that you had during the 70s and 80s. So the rolling 3-year correlation is basically as high as it's been. And so the diversification from bonds has gone way, way down. And my worldview is that inflation's coming down. We have some of our own measures of inflation that say inflation is not as high as the official numbers. We get into all that if you want. But when you buy a 30-year bond, it's not next year's inflation that matters. It's your inflation over the next 30 years. And there's a lot of people who are now have this memory of inflation. And so I think, alternatives, stuff like what Bob does at Unlimited, very important. Things that finding non-correlating assets, things that are not, people have too much bonds and not enough of these other diversifiers. Gold is certainly one of them, that you could find these other things, I think, but other hedge fund type stuff like what Bob's doing, other alternatives, other just less correlated assets are very important.
Super interesting. Did I hear you right, Bob? You said people are under allocated to gold and that their gold allocation should match their bond allocations. That's what the research is showing?
Yeah, if you're trying to build let's say an optimal diversifying portfolio relative to a stock portfolio, your best bet is to hold roughly on an equal risk basis bonds, gold, and diversified commodities. Like that is and then, as Jeremy highlights, and I appreciate, alternatives also in that context can offer benefits, diversification benefits relative to stocks. The point is that there's lots of other solutions that would help protect investors from a wider variety of outcomes than what we've seen over the course of the last 30 years up until COVID began, than simply holding a bond portfolio as a diversifier to your equities.
Now, I think I might be part, not me personally, just by me, but me with Professor Siegel as the sort of leader of talking about this. So Siegel's classic chart on stocks, bonds, bills, gold, and the dollar, he had shown 200 years of data. For the central chart from our book is, stocks did 6.8% after inflation going back 200 years. Bonds did 3.5%. So you have this 3% equity premium, real return. Now, a lot of people say, hey, the Fed's at 5 3/8, get 5.5 in floating rate treasuries. Does that make stocks a much less better deal today? We say, no, that's not the right way to look at the equity premium. You gotta look at it versus the inflation-adjusted bonds. Stocks are real assets. They grow with inflation. But, you got to call it a 2.5% equity premium today, still much better stocks versus bonds. Gold did a little bit less than 1% over 200 years. Over the last 80 years, is much higher. But over the 200 years, it kept up with inflation, but not quite 1%. But so the challenge has been, where do you fund gold from? Do you sell stocks? Do you sell bonds? I think Bob just made a good case for selling bonds. Could definitely agree with that on the sort of lowering correlation between stocks and bonds. I think one of the things that we're working on is these capital efficient solutions where you could add gold futures on top of stocks. So you don't have to sell your stocks. So you could maintain an equity allocation with just the gold overlay. And so that's something we launched 2 years ago. We had a lot of success with a stock and bond combination where you added like a 90-60 of stocks plus bond futures. The whole point was to be able to add complements like Bob's alternatives to that, to say, how do I fund the alternatives? I need, I want to keep a 60-40, but I add alternatives by doing the stock and bond combination. But with this idea that bonds are correlating less, maybe the gold overlay is the more interesting overlay. And so 2 years we did that. I think that proved to be very impeccable timing. And if you look at those gold futures, GDE is the ticker for our stocks plus gold. It's done incredibly well this year and the last few years. And I think more people should be thinking about that as a way to add gold without sacrificing your stock allocation.
Right. I think when we have the conversation, mainly it's around paring back on the bond portfolios in terms of where the dollars are looking to come from. But again, I think I would agree with both Jeremy and Bob around the under allocation that we see, and it's to our surprise. Good time to be considering it, even with the prices where they are.
That's great. So, Jeremy, you touched on one of your ETFs that you have with the gold overlay. Obviously, Joe, there's ETFs like GLD. Can you guys talk about, how investors should go about choosing the right gold investment vehicle for them? Is it just about costs? What should they be looking at?
Well, I think that the question of where you fund it from, to me, sort of the asset allocation question becomes that real interesting question. So we talked a little bit about that. We talked about the S&P it's not our fund is our own version of the 500 largest stocks with the gold futures overlay. There's a whole debate over miners versus gold, and they've been a terrible place to be for 30 years. So some people say, hey, they're terrible stewards of capital, and that don't avoid the miners at all cost because they've been such bad investments. That's other people, and I think it was Druckenmiller who recently added to Newmont and a few of these other miners in one of his recent filings. People are thinking, hey, now with gold prices so much higher, their break evens they're actually making a lot more money. We'll see if they actually manage their capital appropriately. They do more buybacks and dividends and return capital to shareholders. We'll see that it proves to be true. But we also did that same gold overlay on top of miners for sort of real levered play on the idea. So that there's a few different ways to do it. People are always cost competitive. They're looking for the lowest cost products always. I think you see that in all ETFs. We see that in Europe. We see that here in the US a bit, sort of the flows going to the low cost, but people will look at different considerations and different things on what products they're looking at.
Yeah, just on the mining point, I think it's actually an interesting point, Jeremy, for sure. We publish information on the all-in sustainable costs, and actually with the higher prices, for sure, most of the earnings for these mining companies should be improved on the basis of them having the ability to manage that number in addition to their financials. We would recommend people, if they're looking for the purest exposure of gold, the most cost-effective is to look at physically backed gold ETFs, whether it's GLD or any of the other instruments that are available listed in the US. We would start there and start the conversation there, keep the analysis at that level. And again, you need to understand liquidity. You need to understand that total cost calculation, but management fee ranges today are wide and give you a lot of choice. So I'd say if you're looking for the purest exposure to just the metal, the physical backed gold ETFs would be where we would recommend people to take a look.
Bob, earlier in this webinar, you touched on kind of the macro outlook, and you said something to the effect that the global macro outlook is supportive of gold. I know you talk a lot about macro on Twitter and things like that. Can you tell us what your current outlook is for interest rates and inflation, both in the US and globally, and what does it mean for gold going forward?
Well, I think when you're thinking about, as I mentioned before, when you're thinking about gold, it is a global asset, and best to be thought about the global supply demand. And so you can get sort of quickly focused on the US and the prospects for US monetary policy, et cetera. But that really is pretty divergent from what we're seeing across the rest of the world, which is, after a period of elevated inflation, a shift towards inflation moderating, and a shift towards central banks either shifting to easier monetary policy, like in Europe or the UK on a prospective basis, or maintaining significantly easy monetary policy in a place like Japan, or not yet delivering the type of easiness of monetary policy that's necessary to create sufficient economic strength in a place like China. And so you sort of put those all together, that is an environment in general on a global basis that generally favors hard assets relative to fiat. I think if you look globally at other commodity prices, if you look at a balanced portfolio, not just gold, but if you look at, say, the CRB, pushing basically at or near multi-decade highs, that's reflective of the overall monetary environment that we're transitioning to, plus increased global geopolitical tensions and conflict, and gold likely benefiting from a similar dynamic of easier global monetary policy in response to weaker economic conditions, particularly in the places where there's demand, risks of currency depreciation in places like China. And then, of course, we have to mention the geopolitical constraints where, in short, we are transitioning at a minimum from a period of significant globalization to deglobalization, and the threats to those countries that hold an adversarial relationship with the West when it comes to their large fiat-based savings portfolios through reserves is necessarily causing them to shift about as fast as they possibly can into holding gold and other hard assets. And so you put that all together, we could talk about U.S. monetary policy, and like on the margin, I think it's probably going to be tighter than what's priced in, and there's still some inflationary pressures that still remain. Jeremy and I get to debate that on Twitter on a regular basis. But it's not real. But it doesn't really matter. It's not the story that matters. The story that matters is the geopolitics, the global shift to easing, and the exchange rate pressures that those countries are facing right now.
I think that's well said, Bob. And I would emphasize the fact that underpins the fact that the 14-year trend I highlighted with central banks is likely, in particular amongst the emerging market central banks, to be something that they continue to look at gold and to continue to add to their reserve portfolios. When it comes to geopolitical risks and the tensions with the US by these banks, I would say it's more of a situation that they want to have access to a liquid instrument where they can trust the credit risk in it. And I think that that's more driving their addition to the portfolio than the fact that they might be worried about sanctions or seizure of their assets. But it's on their mind. And it's a trend that we've been seeing increase over time. And we have an annual central bank survey we run, like so many other people do, but we'll have another version of that out next month. And I'd encourage everybody to take a look, because in there we specifically talk to the drivers of why they're adding to their portfolios. And I think in most of those cases, there are homegrown concerns around inflation. There are homegrown concerns around access to a liquid instrument and understanding the credit risk, and the overall concerns around fiscal concerns with the US probably driving more gold allocations to them versus the risk of a sanction environment freezing their assets.
Although China's not going to tell you they're afraid of invading Taiwan, so that they're going to not want to have treasuries. I mean, that they're not going to be honest on that. But I'm not saying they're going to invade Taiwan, but I'm just saying there's definitely a new sense of you had the US sort of surprise a lot of people with what some of the freezing of the assets. And so it's a natural reaction for China to take money out of treasuries. But then the question is, where are they going to put it? That's the problem, is they're selling all this stuff to the US and they got to put the money somewhere. And so gold is definitely one of those assets that can handle it. And so it's definitely an interesting case.
China's been on the leaderboard for buying gold for the last 10 years amongst the global central banks, whether it's developed or emerging. In addition, I think that what we've seen is that they have been quite comfortable just taking it on in large scale and publicly, and making sure that they're disclosing that they're holding it, for sure.
Bob, do you have a sense of when the best time is to buy gold? We've obviously seen a huge run up in prices. Does it make sense to wait for a pullback or just to buy here?
Whenever you're thinking about a strategic portfolio allocation, which is sort of where I take your question and where most people are wrestling with, particularly trading between bonds, out of bonds, and into gold, you don't want to be, diversification is crucial. And so you want to move towards diversification, but you don't want to have a particular sensitivity to a moment in time in terms of the returns, or trying to market time a particular moment. And so let's say you're there with a 60-40 portfolio and you're thinking, hey, it makes sense for me to move sort of 10% of my allocation into a gold, into some sort of gold asset. That's the sort of thing that you could do over the course of a couple of years as part of sort of your natural rebalancing, or even better, if you get incremental inflows into that savings portfolio, channeling them to gold to sort of dollar cost average into it. Most people should not be making tactical bets on gold. It's hard enough. It's hard enough when the professionals are doing it. For the everyday advisor, this is really about building a robust strategic portfolio.
So just to add to that, first quarter of 2024, we saw the highest average price of gold ever, 2070. So the sustained strategic allocation to gold from central banks, Eastern investors, the strong case for it keeps continuing to support the floor of gold. So to Bob's point, let's not recommend timing the market or betting the market. Just if you feel good about your allocation to gold, understand its performance characteristics, then make the allocation and deploy.
That's great. So I got about one question left, and then I'm going to start taking audience member questions. We already have 6 or 7 questions in the queue, so I want to get to those. But before we go there, Joe, I know gold demand gets all the attention, but what does the gold supply picture look like? Has it changed at all over the last year or two, or has it been steady as it goes?
Well, it's been record setting in terms of first quarter, even for 2024, in terms of the amount of gold that's getting put into production, which is great. I think that the outlook for production and the mine sites coming online over the next 2 years looks robust. After that, it looks like it could be tailing off a bit. So what I'd say is, at this stage, remember, gold can be sourced from supply that comes from mining, but it also can be recycled. I would keep an eye on both of those dynamics to continue to bring gold into the system. But right now, we're continuing to see a strong performance on gold. And Jeremy pointed out earlier that these higher prices are helping. It's helping keeping them above the all-in sustainable cost to get production into the system. Like I said, first quarter of 2024 was near 900 tons of production, which is a record set for the community. And actually, ultimately, it looks to be in good shape. But beyond 2025, I think we need to see how the industry shakes out a bit.
That's great. Okay, now we'll get to the audience questions. The first one is pretty simple. They're asking, is gold considered an alternative asset? That's how this listener tends to label it. Would you agree with that, Bob?
I would. I think gold is the most fundamental asset that has existed for thousands of years. It's more fundamental than debt or equity. So it doesn't seem very alternative to me. I think the thing that it is alternative to is how most folks allocate their existing portfolios. So it seems novel and unique in the context of traditional advisor portfolios. But if you think about how people have saved over millennia in all sorts of different geographies, they've always gone to one thing, and that is gold.
We're also seeing a lot of questions related to central bank buying of gold. Joe, I know this has been one of the biggest drivers of the gold price. This listener is asking whether that massive buying we're seeing by central banks can be sustained going forward.
Yeah, I think definitely is the short answer to the question. More detail on that. Again, the drivers have been beyond just a short-term factor around geopolitical tensions or risk of sanctions, at the fundamental nature of what they're looking at. Just to highlight a couple of other factors that have been in our survey. We expect to get updates on the survey, like I said, next month. But over the last 5 years and looking forward 5 years, diversification away from the dollar and the euro is a factor that these central banks have identified as a priority for them. Again, looking at homegrown inflationary challenges, systemic issues onshore that they may be facing, or even looking at the need for a liquid shock absorber in their portfolio, they see that the benefits that come from adding gold to their portfolio. I also think that the fiscal challenges that the U.S. is facing over the next 3 years is probably something that's going to be on their minds, looking at how the dollar and their dollar assets will perform. I think that they look and see the value of gold, and they're continuing to make the investment. I'd also highlight that one thing that we see with the emerging market central banks is they are underinvested in terms of what they could be having in their portfolios relative to where you would see the levels of gold held by the developed central banks. So the developed central banks have a number closer to a 10%, where we see about a 3 to 4% level for the emerging market central banks. So there's headroom for them to continue to add.
Jeremy, do you have any insight on, buying gold, through ETFs versus buying gold physically? One listener is really curious to know what the pros and cons of each is.
Yeah, I mean, some of the World Gold Council products that they talk about, they hold bars in vaults. So there's this question about are they being audited? And I know our team has visited our vaults in London, and we have London vaulted gold, we have Swiss vaulted gold in Europe, and there's these secret locations where they go to. You can't bring people there all the time, but we have gone down. We have brought people to see the gold. There's different ways to do it all. I mean, I talked about when you think about what Bob said, people are only 1 to 3% allocated, or maybe even just 1% allocated, with the people who have so under allocated. I think people have been reluctant to give away, again, their stock portfolio. So I think where we added the gold futures overlay, it's not physical, but it's a way to get gold in your portfolio without sacrificing your stock allocation if you didn't want to lower your stock allocation. So I think there's all sorts of pros and cons of different ways of doing it. There's trade-offs with everything. But I think the big picture is try to find ways to add these other diversifiers, given that we're all picking on bonds, but bonds are not the diversifier they used to be. You need more alternatives. The gold fundamental, I like what Bob said there. You need alts to stocks and bonds, let's put it that way. And gold is one of those, and other alternatives are also useful.
Bob, do you think about silver at all? I know silver has had a big move up recently, but it's far off its highs, unlike gold, which is hitting record highs all the time. One listener wants to know, silver versus gold, where do you stand on that?
Yeah, I think silver has long been a less reliable portfolio asset when it comes to performing consistent with those sort of macroeconomic fundamentals. And there's a variety of reasons related to that, related to its perception as a storehold of wealth, its usage industrially, and the fact that it is less of the sort of standard savings asset in a global portfolio. And so I traditionally have not invested in silver or really worked too much in silver, given the ambiguities, whereas the return properties of gold have just been much more robust and consistent over the course of decades or hundreds of years. So if you're looking for that diversifier, I think gold really is the best choice. If you're going to go with something like silver, you really have to understand the fundamental supply-demand dynamics in that market, which are not the same.
Right. So maybe I can add. I think that in addition to that, there was a question about the industrial use for gold, and I mentioned early on in the conversation that technology is a component of where gold gets consumed. So yes, there is the industrial component of gold's demand, but it's small relative to the monetary or consumer drivers that play a big part in what Bob, Jeremy, and I have been talking about throughout the course of the webinar. But if you think about AI applications, that actually is having an impact in the quick early adoption of gold and technology, as its superconducting capabilities is pretty high, and actually, it's an excellent conductor of electricity. But gold tends to tap out in terms of its technical application, or be very minute in terms of its application, whether it's in medical or testing devices that go along with healthcare. And it tends to be expensive, but it's early in its application, but then it tends to tail off as the industry tends to find lower cost substitutes for the gold in the application. But it's kind of around a 10% number in terms of the application for gold, and that's how people should think about it. And back on this is gold an alternative point, I thought I'd just add one thing. The best way we get people to get their head around how gold can help you is to stop trying to bucket it as a commodity or an alternative or something else. Just simply think about what your challenge is and how this asset and its characteristics and its attributes can help you when you think about adding it to the portfolio. It's not a very hard thing to do because we have tools that can help you get a long-term expected return on gold. We have tools that can actually show you historical volatility and its impact, and really just give you the analysis of how it fits your portfolio instead of saying, which bucket should I think about putting it into at this stage?
And Bob, one listener asked whether you could comment on whether there's a specific percentage allocation that you recommend people hold in terms of gold in their portfolio.
Well, my basic thought on gold, it's sort of portfolio diversification benefits are pretty clear up to 10%. I think they're beneficial beyond 10%, but 10% is you get a lot of the portfolio diversification benefits. And at the same time, you're not introducing so much tracking error to something like a traditional 60-40 portfolio that you would create risk in terms of your, peer risk or other risks like that. And so, it's certainly a good place to start, is something like 10%, which is roughly what I have in my strategic savings portfolio.
And we've touched on this, but one listener was interested in knowing whether some of the central bank buying that we're seeing is because of, the US blocking the Russians from getting access to the assets that they held in the West, and other countries might not want to run that risk. Is there any insight on that?
I thought it was related. I mean, it's hard to show any causal effect there, but because they're not telling you exactly what they're thinking, but there's no question. It's correlation causation. It's hard to say, but if you were sitting in their shoes and you saw them freeze the assets of Russia, and hey, maybe we do something, we don't know what we're going to do, but maybe we would get on the wrong side of things. It would make sense that you try to diversify from just holding treasuries that the U.S. can block. It's common sense.
I'd agree with what Jeremy's saying, but cite two other factors that maybe will help people understand, maybe systemic moments that are actually driving central banks to keep adding above and beyond the portfolio benefits that they get from it. The first is during the election outcome in Turkey, the central bank was able to deal with onshore challenges around the Turkish lira. They were able to sell coins and other small denominations of gold into the local community, buying back the lira, shutting off imports of gold, so effectively stabilizing their onshore political challenges and the currency challenges that they were facing. So that's one good example where they needed gold to actually handle a homegrown challenge that didn't have anything to do with Russia or invasion or the US sanctions or anything along those lines. So that's one good example. We've got a write-up on that on our website. I'd encourage people to take a read of that. And then secondly, I'd cite the fact that Poland has surfaced as a central bank that continues to add to their portfolio the diversifying benefits of gold. And I'd encourage people to understand the proximity of where they are in the eastern part of Europe. So I'd say, again, maybe not necessarily a concern around the US, maybe just concerns in general around what assets they're holding, why they're holding them. And those are two kind of systemic driven moments that I'd add to what Jeremy has said about the obvious factor of the US potentially putting a freeze.
Well, fantastic. We're just about out of time, so we're going to have to leave it there. Bob, Joe, Jeremy, it's been an absolute pleasure. Thanks so much for sharing your insights with us.
It was fun. Thanks, guys.
Thanks for having us.
Yeah, thanks so much for having me.
And a big thank you to everyone tuning in today. A replay of this webinar will be available on demand in the Media Center section of the ETF.com website. Have a great day and see you next time.